Welcome, Pat, and happy Wednesday. And thanks for joining me in the middle of the week to watch the news conference with the Federal Reserve.
Watch the Federal Reserve in action live. It's almost like a sporting event, you know?
Yeah. They said we should lay down some odds here. But what I'm really glad you joined me about is I want you to talk about this article that we saw here on Mortgage News Daily and how the Fed's actions on today's like today, how do they affect mortgages?
Yeah, I mean, it has a counter effect that the average person thinks, they're raising rates. But like that article said, the bond market, the mortgage-backed security market, and the treasury market trade every second of the trading day. And the Feds only meet 8 times a year. So once they start sending out messages that, we're probably going to raise, rates 3/4 point, when you start getting consensus from the Federal Reserve people, they can price that in. Going back, they start pricing that in 6-7 weeks. Like you saw the rates, obviously the last 40-45 days have gone up. They've already priced that in. So once that event happens, they're moving on to the next event 6 to 7 months down the road.
Yeah, I like what they say here because the market can show up to the party so far in advance of the Fed itself. It's not uncommon to see mortgage rates move in the opposite direction of the Fed on the day the Fed makes its move. So that's what will be interesting to track. Right now, we're sitting at a national average of 6.47. And what I thought we'd do is we're going to watch Chairman Powell here and listen to him. And while he's talking, we're going to, was it only 75? I haven't heard yet. Have you?
Yeah, it was 75.
Was 75? Okay.
Yep.
Okay, good.
And I think that I was saying, obviously it tells me in my crystal ball, I said, maybe, they were talking about maybe a point, 100 basis points, but you think, the more I thought about it, 100 basis points probably would have sent, it probably does two things. It would have sent the message that, hey, we're in deeper trouble than we thought, and we're scared. And also, it's almost biting off too much of the cake at one time. 75, I think, looking back on it, was probably a more realistic number. That way they can kind of keep that number and, 75 the next move. But I think 100 basis points would have sent a really negative signal the more I think about it.
Well, what did you see this morning? I put your chart up here. What?
Yeah. I mean, basically this right here, it was down like minus 3 basis points, the 5-year coupon, the mortgage-backed security 5% coupon. I mean, the 10-year was at 3.569 here, as we see right here. We saw a high of 3.61. At 11 o'clock, it went from like -3, -4 to like -40 or -39. So it kind of reacted, the gates negatively, but then it's starting to come back.
Is that what I'm seeing here then?
Yeah, correct. Yep.
Okay.
Yep. So, I mean, we saw yesterday, go back to my chart. This H right here, this is yesterday's trading. We saw these are bond prices. Obviously, bonds inverse relationship, rates go up. So the rates, this is obviously bond prices. This is what Barry Habib calls a bullish hammer. This was actually a positive. It's a technical term, bullish hammer, but it's basically kind of a trend in the charts saying that, okay, we hit, you saw how it kind of blew off here, hit the line and came back up. That's kind of a hammer. So that was kind of a bullish sign saying, hey, maybe we've hit the bottom or the top in rates for the time being. So it was a good trading day yesterday, technically, in the 10-year treasury.
Well, in some other things that I've read, here's the interesting thing is we're looking at what his conversation is going to be about today. Fed's tough task. History shows inflation takes an average of 10 years to return to 2%. So they've had their target at 2%. It's possible that he might announce that they're going to tighten until we get to 4%. here's some of the things I'm going to look for and what he's going to talk about. And he's mentioned the word pain before, and I know that the market's waiting to hear a little more details into what he calls pain. He's saying unemployment's going to go up. Do you think he'll spit out a number that says how far it'll go up, and how, and will we be in a recession? How long will it last? Because this task that they have of pulling back this inflation rate and all of this QE that's been going on for 10 years is pretty big nut to swallow there. It's soft landing. I don't know.
Yeah. What is, what technically, what, like you said, you need to define some things. What kind of pain are we going to see? They keep it very general, obviously for a reason, but what is a soft landing? I just tough to decide, tough to define that.
Yeah. I think the interesting thing that I read too is talking about, what does it mean when he raises, this is the overnight rate that he's raising, and how does it affect interest rates in general? And so one of the things that I read was not only is it going to affect your pocketbook, and but it's going to affect our national debt, because our debt is 125% of our gross domestic product now. And the interest on that debt has been nothing for the past few years. We've been at almost a zero rate. You get that up to like 4.5. Now your interest payment on the debt is going to be more than national defense and Medicaid. That's kind of scary. So
it is. I mean, it's that's why they got to get the stuff under control. They've got it. I mean, I think, like I said, all this spending that they're doing, they've got to rein that in. I mean, it's ridiculous. They got to rein that in. I think if they rein in, they open up the policies in terms of energy. I mean, that's just my personal opinion. I think, that would go a long, long way. But like we talked about the last couple of telecasts, it seems like the Federal Reserve and this administration are they're not working together at all.
Be interesting to hear if he addresses that. He has made comments before when he's spoken, but he hasn't ever mentioned that at an official press conference.
Yeah. Yeah.
Is he going to reach the point that says, hey, folks, I can't do this alone?
Yeah.
So, and the other thing, the important thing is too, Pat, and you and I just talked about it before we came online. This is not going to go away in a year.
That's why I think you have to split up. Like I talk about the last several months, you have to split things up in segments, periods. I think this is not transitory. Like we talked about a year and a half ago, this is not transitory.
No, and I'm seeing improvements in lumber, improvements in oil, but not seeing any relief in food. Question here, Pat, you said previously they're selling mortgage-backed securities, correct? Do you see them selling more? And what will that do to the housing market?
Well, they're not sell. I mean, they basically, according to the Federal Reserve schedule, they're not buying any for the next month. But they're just basically letting, just through natural roll off, if they have prepays, they're just letting it roll off. I mean, it's going to have some effect. I don't know what, obviously I don't, it's a bigger question for me than me to answer, but I think what we have in front of us is a lot bigger than just the mortgage, just the segment of mortgage-backed securities out there. I think they can handle that. I mean, like you said, the markets kind of take care of themselves, and we have refinances. That's why back in 20 and 21, we saw hundreds of billions of dollars, them purchasing it, because there was hundreds of billions. And, we had a $4 trillion mortgage market, last year. Now they're talking like, I'm doing the exact numbers, but it's gone from 4 trillion down to say 2 trillion. It's cut in half. and the refis are down about 90%. So the supply is just not there. So that the markets in themselves are helping that, if that makes sense.
Yeah. So they're not dumping them, selling them back to anybody. They're just going ahead and expiring on their own. They're not buying anymore.
Yeah.
Now treasuries are, that's kind of a different animal. The way that's worked from what I've read is that the Fed will basically they add a bunch of digits to the treasury and then give it to the banks in the name of reserves. And then when the banks have all these reserves, they lower their rates and then get the money into the circulation in the economy. Now they're doing the opposite of that. They're pulling it back and they're lowering the bank's reserves. And so that's what's raising interest rates.
Mm-hmm.
And they're walking this fine line of, okay, we got to pull this back. When will we know if we've pulled back far enough? And how bad is this going to hurt? And when Chairman Volcker back in the 70s and 80s did this rather aggressively, the economy was actually, believe it or not, in better shape. Our debt was 30% of GDP compared to now where it's 125% of GDP. So while he inflicted a lot of pain, he didn't inflict a lot of costs to the federal government for interest rate debt repayment.
Mm-hmm.
And so, but it still took unemployment up to 10%. So let's hope he doesn't have to clamp down that hard. And what he said last month was the reason that Volcker had to clamp down so hard is because he didn't do it soon enough. And that's interesting because there's a lot of chatter that maybe Powell should have started this last year.
Mm-hmm. Mm-hmm. Yeah.
He wouldn't have to be as aggressive. So money's a funny thing. It just moves around and all we can do is watch. So he's
it's amazing. That's being economics. I mean, studying economics, it's amazing the flow of money, the supply and demand, and really the psychology of money, is really fascinating to me. But so I'm just looking at this. Actually,
watch the waving hand guy. That poor guy. I pick on him too much. There's a, speaking of people just on YouTube, somebody said a question this morning, why are, your real estate agents letting open door live in your head so much? And how come you're all talking about it so much on YouTube? Well, they're a big part of our business. And we're talking about it for a couple of reasons. One, we can't believe the pickle they got themselves into. And number two, we do a lot of transactions with them, selling their inventory. And in that light, talking about iBuyers, I'm hearing, and I haven't been able to get validation, but I'm just hearing it from real estate agents that OfferPad canceled everything this week or last week. They just, if you were under contract with them, they got a hold of you and said, we're canceling, no more.
I heard that. I saw that. Somebody posted, loan officer said he didn't give the name of the company, but he said that he heard it, because it's not, it's
the new economy is right now.
You walk a fine line in terms of saying the name of the company, but he said that they are rescinding contracts. That's not something I don't know if I could trust a company like that.
Yeah, they did it. This is the second time they've done it to us.
Well, they did that. Remember, they did that. They started doing that in COVID. So they pulled back real quickly in COVID. And I mean, if you're just an individual, buyer or seller, is that a partner? Whether it's a small company or just an individual person, is that somebody you want to partner with or do business with?
Yeah, if it's getting dicey, I mean, it was very enticing because they were paying some pretty good money. And Open Door is losing money on 74% of their Arizona holdings.
Yeah. Well, you can just see the listings.
47% in California. So they went.
Yeah, I don't know how that's not a winning model in my book. That's for darn sure. I mean,
well, talk about coming up, but I don't see it yet. So
talking about Powell, it's going to be interesting to see. I mean, how how long do you keep doing this as far as raising rates? You know, I know they've got a target, but at what point do they say what's going to, say, okay, we've done our job? I wonder what their economics are going to look behind that after they're done.
Yeah, and I think that's going to be one of his main points today. Because everybody has, and then in these news conferences, I don't think it's a Q&A, is it?
No, I think, I don't think so. No, he pretty much comes out and says what he's going to say. But I'll tell you one thing. Can you imagine? He probably didn't get any sleep last night. Can you imagine? Like, oh, Jesus, he probably tossed and turned all night.
Okay. Hey, we should do this, Pat. We should get a stage and put a bunch of Arizona flags behind us and then stand up there and tell everybody what's going on in real estate. We should. Why don't you work on that for us? So
I'll get that house.
We'll get it. I'll get the podium.
Okay.
And,
all right.
And then we'll just get friends. We're probably going
we'll get a bunch of friends. Yeah. Or actually,
that means we're going to have to provide liquor. So
yeah,
here we go, folks. He hasn't affected anything yet.
No. So this is kind of like, what's that one
Good afternoon.
show that does the movies? Okay.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
He's teeing up the bad news.
Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%.
Ooh,
in addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates.
You think?
Yeah, no kidding.
Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer run normal level.
That's a little lower than I thought they'd come in.
Inflation remains well above our 2% longer run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
Yeah.
As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done.
I haven't heard the word pain yet.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilek from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, I think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
He's trying to avoid pay increases. That's what he means by softening the labor
Thank
market.
you, Mr. Chairman. Steve Leisman,
Yep,
CNBC.
cutting people out.
Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates? Or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So,
Good question.
of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time that you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
There you go.
Oh, got a little humor.
Is it linear? Do you keep raising
Loosen
rates?
up the crowd.
Pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy. The rate increase time to catch up in the real economy. Thank you.
Yes, when you're all
So I think
protesting in the
it's
streets.
very hard to
Yeah.
say with the precise
We'll pause.
certainty.
Yeah,
the
we'll
way
pause
this
it then.
will unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time, but we're not at that level. Clearly, today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Lowest level of might be restrictive. That's interesting.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation.
What about spending?
Let me just say how much these factors will turn out to really matter in this sequence of events. It remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Well, at least he doesn't have to flip through his binder like Jean-Pierre to answer the question.
Wait,
hold on a second. Let me get that.
Colonel, you said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so
It's just about 15%.
and we believe that we need to raise our policy stance overall to a level that is restrictive. And by that, I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting, and talk about it in all of our meetings. And you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve. And that is also an important consideration.
Hurry up, Jerry. I got a call coming in.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly.
So rates are going to be pretty volatile.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here, given there's some discussion now of overdoing it. What's the incentive to continue
Look at that
right now?
Mm-hmm.
Is it
Go figure.
lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still strong today?
So what we've seen is inflation our expectation.
He said something they didn't like.
We would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation.
Well, Pat, I think we definitely got the gist of where he's headed. He's now kind of repeating the same things because he's kind of getting questions saying the same thing, and he keeps saying we're just going to clamp down hard until we see results, and we're going to do it quickly.
Mm-hmm.
So his unemployment was an interesting take. He was saying that a lot of the employment may just happen because the open jobs that aren't getting filled may just go away.
Yeah. Well, I want to know, they keep talking about the 10.5 million job openings, right?
Yeah.
I would love to see some type. I mean, I know this is probably impossible. I would like to know the quality of what kind of jobs those are.
Yeah.
Are they, obviously, because it does depend. To me, if you had 10.5 million job openings at, say, and not to, I always say any job, if you're working, is a credible job, whether you're a janitor or you're working at McDonald's or you're a CEO of a company. It's a job is a job. And, I try not to, demean anything, but are those 10.5 million jobs at, raking leaves at the county park, or are they, 10.5 million jobs at, say, McDonnell Douglas or Lockheed Martin? What's the quality of the job openings? I would love to, be interesting to see that. But like you said, there's, and that's what he's obviously relating to, is that there's a lot of service jobs out there that are just, like you said, a job is a job. I don't mean to demean any type of labor, because like you said, if you're working, that's a hell of a lot more credible than sitting on your couch. But I think it does matter in the quality of the jobs.
Yeah, well, we know there's a lot of airline pilots shortages out there. That's for sure.
Yeah, I mean those guys make $200,000 a year. Now that's the type of what I'm talking about. How many, jobs out there are, but
Yeah. And Bobby's talking again about, what's going to be like when they finally unload mortgage-backed securities. And what we're saying is they're not unloading them. They're just not buying anymore.
yeah.
They're kind of letting that just take care of itself over time. And I think, there's a couple charts that I saw in here, and they projected numbers out to 2025. And so he wasn't putting anything up that says, and we expect things to be a lot better by the end of 2023. 2023 is going to be that adjustment period. And they're saying, well, how do you know when you've clamped down hard enough and you can pause? And he's just saying, well, we're going to look at everything. We'll try and figure that out at the time after we look at all the data. So he
said too, everything's, he said, what, 6, 12, 18 month trailing. They always look at trailing numbers. They're not, they're not talking to, I know they are probably, but I was talking to my buddy who's in the wholesale business, and he said, he foresees some bad news coming out the next 6 to 12 months based on what he's seeing on the wholesale people. He goes, people are clamping down. Business owners are clamping down. Their inventories are bloated. They're pulling back. And he goes, you're not seeing that right now. You're seeing the inflationary. We're looking at the inflationary numbers now, but my buddy's talking about 6 to 12 months down the road. So, yeah, look at that. Yeah, I'm glad you flipped back to my chart. We're having a good day now. The 10-year, the 3.51, we saw a high of 361. So we're seeing this bounce off the bottom. And like I said, the 5-year coupon is up 6 basis points, which is a relatively decent, calm day.
Which it always is on Fed Day, except for the stock market. But
look at
Tyler asked the question: did they say when the next increase will be announced? They
meet in November. They meet in November.
Okay.
Yeah. I don't know. I think it's I'm not what day exactly. I think it's the third week. But so yeah, look at the 5-year treasury, or the 5% coupons up 14 basis points, which is a good day. So just goes to show you all the news has been built in already.
Yeah, I think that's one of the key things I was hoping we could illustrate here was to watch it live and see that as we, not that we're geniuses, but it's what the market has always been telling us, is that, this Fed is very transparent. It used to be like in the Alan Greenspan days. He wouldn't tell you what he's going to do.
Oh God.
He would just stand up in front of a podium, and next thing you know, you go, he did what? This guy, here's what we're doing. And I never understood why they had to be so secretive.
Yeah. They're doing a lot. The last couple of years, they're doing a lot better job of leaking, which is kind of good. Actually, obviously a lot of leaks are not good, but these type of leaking information, so you don't throw the whole bucket of hot water on you on one day, or cold water, whatever. It does help the markets kind of, digest, like you had said it with Mortgage News Daily, how the treasury market and the mortgage-backed security market trades on a given day. So we're going to see volatility in rates. I mean, I think short term, obviously they're going to firm up here, but I mean, that's why we see such volatile days now, is that when I wake up and I see the market down, like say this coupon, the 5% coupon down 60 basis points, I'm like, the market's reading into something already. And there's, because you'll see the market react like that, and there's no news out there.
What is this telling us?
That I mean, it looks like the markets are obviously saying that my personal opinion or take on it is that the Feds are doing the right thing. That the Fed, the markets see rates going down, in the future, eventually, reading into, we're talking like next 6, 7, 8 months,
Yeah, it's interesting. We were up like 220 points, and now we're up 187. So that's just a normal day in the stock market. So this didn't do too much. It didn't jolt anybody out of their their seats. But the other thing that I think is glaringly evident is you can no longer say or anticipate that the Federal Reserve is going to pivot in November. They're not. I mean, he's made that very clear that don't even
Yeah.
expect. He could care less about politics. He didn't even bring up the level of spending that we have. He's just not
I know.
touching that. But I think he's not touching that yet. He's going to reach a point where he's going to cry uncle and go, "Hey guys, this you got to pull back." So I hope everybody found that interesting to watch, and I appreciate everybody that tuned in. It's the first time we did it. Just thought we'd do a little side-by-side commentary while things are going on, and it was
What
fun
was
to
that one
watch.
movie? Remember that one show, the year 2020 or something like that, where they had the little robots commenting on the movie while the movie was going on?
It's my son's favorite show. I can't,
remember
what the heck
they
is the
comment.
name?
Well, what the heck was that name? They'd have little robots and the guys in the background. What was what was that?
Something theater.
Something theater, yeah. And you'd have these little guys comment like, "Oh yeah, really? What? Really? Thanks for telling us that." They'd have some smart aleck comments. I thought it was pretty funny.
Oh, I love that. Yeah, that's a great show. I used to watch that all the time with my boys. So, but well, thanks
anyway.
again, Pat, for taking time, and I will
right.
see you on our Arizona News Show tomorrow night at 6:00.
Sounds good, buddy.
See
Have
ya.
a good day. Thanks. Bye-bye.